Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, Canada's economy is softer than expected, leaving worries about recession front and center. And is it time of power for employees, or is that time already over? And as COVID advisory groups are disbanded, a new book asks whether we learned the lessons we need to do better next time. That's all ahead. First, though, for the week that was in business, it's time for the briefs. Strong but getting weaker is the headline on the Canadian economy in the form of a read on growth this week that showed solid performance in the summer months up to July, but evidence that it was already starting to slow with a mild contraction in July. At 3.3% year over year, GDP growth is historically strong, but it was below economists' expectations. It is not so bad that the Bank of Canada is likely to hit pause on its path to higher interest rates next week.
We still have high inflation. The hikes that they've done haven't yet bit. So how much more do they hike?
Meanwhile, the province of Alberta is reaping a windfall thanks to high oil prices, giving it a surprise surplus of $13.2 billion, something the province plans to use to pay down debt. In fact, it will pay off $13.4 billion of debt, choosing not to reinstate inflation indexing on some programs for the elderly and disabled, at least for now. The decline in home prices may have plateaued in August. In Toronto, the average price was up about 2% from July, while new listings were about the same as last year. In Vancouver and Calgary, prices have dipped from July but remain above year-ago levels as buyers and sellers wait to see what the Bank of Canada does next week. A promised tax on luxury items came into effect on September 1st. Vehicles priced above $100,000 or boats for personal use priced above $250,000 will be hit with at least a 10% tax. Business owners and sales organizations in both sectors worry about the effect on their companies and on jobs. Well, the long delays at airports and for services like passports or visa applications are improving, but they're far from perfect, according to the feds. The government struck a task force in June to improve the processes, but they're also asking how they got so out of whack in the first place. They say they've hired thousands of new workers to help speed things along. And those are your business briefs. While the economy is showing signs of cooling, inflation continues to run high and the labor market seems as tight as ever. Contradictory signals, perhaps, or evidence that the economic slowdown might be short-lived. Pedro Antunes is chief economist at the Conference Board of Canada. Pedro, great to have you with us.
Well, thanks for having me.
So let's just start with the kind of growth outlook that we're seeing. 3.3 is a great number for Canada historically, but are we beginning to see that it's slowing a bit? Does that give us a bit of cause for concern as we look into the fall?
Well, I mean, certainly there's some segments of the economy, there's no doubt that are slowing. One of which I think everybody's familiar with, it's the real estate markets, and that is cooling. A much slower residential investment, in fact, a weakening residential investment sector, and that's playing a part in the economy. And of course, when housing starts to ease, purchases of durable goods, things that we use to fill our homes, that eases as well. So I think some segments of the economy are easing. What we're seeing instead, though, is people spending on services, and that's continuing to recover. So I think on overall, we're still looking for the economy to do fairly well in the coming quarters, and certainly with respect to labor markets, I think that's another good sign. Very tight labor market still.
For sure. One of the big problems, of course, is the Bank of Canada is tightening to try to cool inflation, but it takes time to work its way through the economy to be seen in pricing. How do they make sure they're getting it right and that they don't go too far?
Well, that's the big risk, and I think that's a risk that probably, if we see it, it'll come a little bit further down the road. So we're concerned about what might happen in perhaps the start of next year or more into 2023. And absolutely, it's a difficult balancing act, and the Bank of Canada knows that it's got this one tool, which is raising interest rates, and let's not kid ourselves, that just hits consumers harder to try and slow what the bank calls aggregate demand. That's essentially consumer spending, and if they hit too hard, then we could end up in essentially a weaker environment or negative growth or a recession. Let's hope we don't go there, but right. That's the big risk around that.
We only got about 30 seconds, Pedro, but when we think recession, most of us worry for jobs, right? That's the way it hits us hard. We don't really care what the GDP is if we have a job. Do we expect a recession to bring job losses?
Well, this is, I think, where the good news lies. I think there's still lots of vacancies. Most organizations across the country, when you speak to them, they're desperate to find more workers. So I think there's a lot of accessibility to absorb weaknesses in certain segments. The other important piece, of course, is retirements. People are leaving on retirements. The baby boom cohort, the last of them, they're all going to be going out in the next few years. So that helps kind of keep the balance in the labor market.
Pedro, great to have you with us. Appreciate your time.
It's a pleasure. Thanks again for having me.
Pedro Antunes is Chief Economist at the Conference Board of Canada. Coming up, there are jobs to be had in Canada, so why doesn't anyone want them? Stay with us.